All right, well, let me start with the introductions as people log in. For those of you that don't know me, my name is Brennan Carson. I'm a portfolio manager partner at Equate Asset Management and also head of our private client division, Solution Wealth. Beside me, my friend and colleague, Jean-Pierre Laporte, JP as we call him, because us Anglos have a tough time wrapping our heads around Jean-Pierre all the time. I'll let JP introduce himself in a minute. Appreciate everybody joining us. We are going to spend about 25-30 minutes going through our slides, talking about the whole idea behind pension strategy for business owners, for business executives, and really a very well documented but not particularly well-known topic of really the tax strategy and benefits in and around pension planning. So again, with Zoom, you're welcome to use the Q&A button. Those will pop up to us. We'll be able to address them as we go through, or at the end, we'll save a few minutes. We will send out a copy of the slides and the video recording, both to those of you who can join us. And also, there's a number of people who want to get a copy of it who weren't able to make it today. So I'll just start. I'll let JP just give you 15-20 seconds of who he is and his background before we get going.
Yeah, thanks, Brennan. So my background is as a pension lawyer. I've been practicing pension law for 22 years now. Did part of my career on Bay Street and some of the big firms that you're maybe familiar with, like Osler's, Bennett Jones, and Baskins, where I was a specialist in the area of pension law and employment benefits. So about 11 years ago, I realized that unfortunately in the small private sector, nobody was really enjoying true gold-plated pension plans. People were relegated either to using an RSP, saving through their corporation, or if they had an insurance broker, using some permanent life insurance product. So 11 years ago, left Bay Street to co-found INTEGRIS and start offering pension solutions to small business owners.
Yeah, and it's interesting. I've told a number of people this story, but really from my firm's perspective, we've been focused on really the portfolio construction side of this equation, building portfolios where we're generating better return, managing risk more effectively. And I actually wrote in my business plan 5 years ago that we wanted to be more active in the pension space, both for employees, but also for business owners. And it was almost a little bit by chance that JP and I have a common colleague that introduced us, and we've been really hard at it for a year now, and it's seemingly a growing part of each of our respective businesses. So one thing I wanted to talk about just very quickly before we get into the slides, I think one thing I've discovered, and JP, you can maybe comment on this a little bit, is I'm alarmed, maybe I guess it's not the right word, at how little awareness there is about pension strategies for business owners and for highly paid executives as an alternative to RSPs or having money inside an opco or a holdco. So, without throwing shade on anybody, why is this not better known?
Well, I'm going to throw shade on a lot of people.
Okay,
and I'm very controversial. No, I mean, the reality is this, and this is the statistics from the CRA don't lie. There's about 1.5 million Canadians that could have a type of pension plan that we're going to be talking about today, and less than 2% are using them. So either the product sucks, and that's why 98% are shunning it, or there's a lack of understanding, lack of awareness, lack of education about these complex pension rules. I tend to think that it's the second reason, that because of the way that the financial institution is structured, there's no real economic incentive for a lot of the brokers to get into this business. Because if you are selling permanent life insurance, you collect a upfront commission upfront. Like when you sell the case, you don't have to wait 15, 20 years to make your money the way you do when you're compensated based on assets under management. Right. So what's the incentive for someone to become an expert in something when the opportunity cost is so high. As for accountants, they're not getting paid. In fact, they might feel like they could be sued if they recommend a pension solution and the money manager screws up. They're going to say, well, you told me to do a pension plan, even though it's the client who selected the money manager. So they're saying, I'm not getting paid and I could get sued. So why would I even talk about this? So they're usually torpedoing these solutions. And then the banks and the large financial institutions that could really advertise this, they're making money, whether you're in an RRSP, non-registered account, TFSA, or a registered pension plan. It's the same fee they're charging. So what's the incentive to spend a lot of money, hire talent, and advertise this? There's absolutely no financial incentive. So if all the members of this community don't see the point, well, I think that explains in large part why this is sort of the best kept secret.
Yeah. Well, I mean, it's again, I've learned more and more about it, and again, as you say, it is the latter. It is the fact that it is a superior product, and simply the awareness isn't there. And you know, amongst the audience we have today that are logging in, and the audience that we're sending this to that I've already spoken with, they come from different backgrounds. There are accountants that we're talking to business owners, we're talking about service providers who deal with business owners, we're talking about people who are not connected, i.e. they're not a shareholder, but they're a high-paid executive. And everybody has the same appetite, which is to save more and pay less tax. So to that end, JP, I'm going to get you to fire up the slides, and we will go through this and talk about really the subject of pension management and more effective solutions than the traditional.
Okay. Well, if I could get someone to give me a thumbs up if you see the slides.
It's all good.
Excellent. Okay. So today we're going to be really comparing and contrasting the two strategies. One that is well known, which is using your corporation, and the other is the pensions. So let's start with the well-known strategy. And you know, we start off by saying Canadian business owners are often presented with a corporate solution to safeguard retirement. What does that mean? Well, it means let's pay the least amount of tax upfront on the active business income that's earned by the corporation, and where possible, use a small business allowance. The first $500,000 are taxed at a lower rate than the rest. $500,000 in Ontario. Most provinces have used the $500,000. I think one province uses $600,000. But typically, it's kept at a low rate, which is great because it's a lot better than paying tax personally. And then once you've paid your minimal amount of corporate tax, then you use the retained earnings and you purchase inside the corporation. You'll open up a non-registered investment account with Equate or others, and you're going to buy a capital producing asset classes like shares or units of mutual funds or something that won't trigger immediate taxation. And the point is that as those assets grow in value, you're not facing any tax during the accumulation phase. So far, you've paid the least amount of tax. And then eventually, this is the third circle here on our slides. Eventually, when you do need to start taking some money out, because that money belongs to the corporation, not to you as the owner, you need to decumulate. So you have to sell some of those investments. And if they're capital gains producing assets, then you're only paying, the corporation's only paying tax on half of it because the inclusion rate is only 50%. So far, so good. And then there's some other advantages that come with this corporate strategy. I've already mentioned that only 50% of the capital gain is taxable in the hands of the corporation. The flip side is that the other 50% creates a gain or a credit to your capital dividends account, your CDA account, which is gold because that allows the corporation to pay tax-free dividends to the shareholder alongside those taxable dividends that the shareholder has to recognize on their tax return. So we have tax-free and taxable income coming out. And then this is a final perception of an advantage. If we don't pay any salaries out of the corporation, if it's all dividends, if it's 100% dividend strategy, then we don't even have to make any premium contributions to the Canada pension plan. And a lot of people think that the CPP is a scam, it's a Ponzi scheme. You put money in and it disappears. One day it's all going to disappear. So for a lot of people who believe that, this is seen as another savings, because these people consider that if I can save the money myself in my corporation instead of giving it to the government, to the CPP investment board, I'm better off. So that's the corporate strategy. I mean, I'm simplifying. Obviously, this could be layered in with using a family trust. You could use all kinds of other strategies. We could use insurance policies, especially if there's a holding company in the picture. We could use the holdco buying a permanent life insurance policy with lightly taxed premium dollars and so forth. But just to keep it simple, we're really focusing on using the corporation. Now, as great as it is, this strategy, this corporate strategy, comes with a number of issues which need to be understood. And what we are going to show in the next 2 slides is that by following the strategy, we're exposing the client's money to about 6 potential taxes. So first of all, tax number 1 is the very first tax we talked about, the income earned by the corporation on its active business income. So obviously under 500,000, the tax bite is, reasonable. Over that, it starts to ratchet up. That's tax number 1. So there's leakage. There's money leaving the system right away. Now, tax number 2 comes when we can't put everything in capital gains producing income, because we want to diversify, and because most of us, maybe Brennan is the exception, most of us are not Warren Buffett. So it's very difficult to pick a stock now and hang on to it for 30 years and never realize any tax on it. So for most people, this is impossible. So they will be diversifying some of those retained earnings into foreign income producing, foreign dividends, Canadian dividends, and capital gains producing.
Well, and the truth is, in this environment, and I love the comparison that I'm some sort of Warren Buffett, but the truth is, in an environment that we're in, even now, with higher interest rates, there are more people buying GICs, there are more people using private debt or private lending investments that are triggering fully taxable interest income.
Yeah.
So as great as it looks that I'm getting this consistent 5, 6, 7% income inside my corporation, it's very punitive from a tax perspective.
And the interest income tax rate inside the corporation, because it's not active business, is 50.17%. So more than half the wealth is bleeds. We've already lost some money up front with tax 1. Now we're losing a big chunk of it as it grows inside the corporation. So that's tax number 2. Then, if we follow let's just use the corporation as my piggy bank, and everything stays in the corporation, even if we move some money to a holdco, it's going to be caught by the more no measures, the tax on passive income that the federal government introduced in 2018, which grinds away at your $500,000 small business allowance if you have too much passive income. So by the time you've generated $150,000 of passive income, whether it's in your corporation or any associated companies like a holdco, you've lost your $500,000 small business rate. So every dollar of active business income is taxed at 26.5% because of the fact that you have too much passive income on the balance sheet. So now we're facing a third tax. You thought you were only paying 12.2. No, you're paying 117% more. On that. So that's tax number 3. But the taxes don't end there. There are more. Because what happens if you die and all your money is sitting in the corporation non-registered investment account and you don't have a spouse? You can't do a rollover of your wealth to your spouse.
Or the spouse isn't, does it make a difference if they're declared as a shareholder of the corporation?
Well, no, I'm just saying that, like with an RSP, if you die, you can roll over your RSPs to your spouse. But if the money's sitting in, the value is trapped in the shares of your company, right? To the extent that you can't do a rollover because you don't have a spouse, you have a deemed disposition under the Income Tax Act. So all this capital now is subject to tax yet again. So we're up to tax number 4. So that could be significant. And then let's say you don't die and you decide to become a non-resident of Canada. You decide to retire to, I don't know, France or Portugal or wherever, US. Yesterday I had a client say, I'm moving to France. What's the impact of on my pension plan and on my other assets? So what happens if you become a non-resident of Canada for tax purposes is you have another deemed disposition called the departure tax, the exit tax. So the government nails you one last time before you become a non-resident. And then finally, even if you don't become a non-resident, and presuming you're not dying, when you start pulling the money out of that corporation in order to enjoy it, because the whole point of this is to have money in old age. So when you start paying yourself a dividend, that dividend is taxable and you have to pay tax again. So we're up to tax number 6 in this system. So a lot of people always complain Canadians are highly taxed. Well, if you're following the strategy, yes, you're definitely highly taxed. So just to wrap up, and again, I'm simplifying, but to wrap up, it becomes quite apparent that only a fraction of that original income that was earned by the corporation up front ends up in the bank account of the shareholder once it has navigated all of these shoals and all of these pitfalls with all these taxes.
Well, and to my question before about the lack of awareness, and again, we're using a very simple model here to illustrate really the power of proper planning within a pension structure. But again, I in discussing this with a colleague a week ago, they said, well, I've got my corp, I got my RSP. I feel like I've done what I was, what I needed to do. It does require to go a little bit deeper to try to understand that, because they think I'm paying a small business tax. I'm not really paying much. I'm giving myself a dividend. I'm not really paying much. And again, there's a lot more going on within the nuances of that structure that people need to understand.
Right, which begs the question, is there another way to save for retirement? And the answer is yes. Let's use a personal pension plan. I could have put individual pension plan. I could have put registered pension plan. It's all the same in terms of the tax deductions that we're going to be talking about. So here we're going to focus on the personal pension plan, which is a registered pension plan. And what it does is that it allows the corporation that sets it up to make contributions and treat them as expenses. And then, of course, just like an RSP, all of the growth on those contributions are sheltered from taxation until such point as you start pulling the money out. So let's go back to those 6 taxes that our friends that are using their corporation to save for retirement are facing. What happens if they shift to a pension mode? If instead of using the corporation, they use a pension plan? Well, remember, I just said before that the contributions from the corporation are tax deduction. So to the extent that the corporation is directing money to the personal pension plan, that first tax doesn't apply in those contributions, right? So we're starting on 100 cents on the dollar, not 86 cents or whatever, 88 cents on the dollar. Number 2, because the pension plan uses a pension trust, under the Income Tax Act, and I've put their statutory reference here, the income earned is exempt from taxation. So that second tax on the growth, the 50.17% on interest, for us it's 0, because there's no tax. Regardless of the type of asset class you're using, it's always 0 tax on the growth. Tax number 3, remember, was this Morneau measure, the tax on passive income. Well, the beautiful thing about this is that, sure, there's going to be passive income inside of the pension plan, but it doesn't matter because it's operating, the growth is happening in a pension trust that is separate and apart from the corporate assets of the company. It's not part of the balance sheet. So it doesn't matter if we have $150,000 or more passive income in the plan, it's not going to grind away at your $500,000 small business allowance. So you're protecting yourself from that tax number 3 that we were facing before when you had too much passive income.
So just on a very simple level, you know, as I look through tax 1, tax 2, tax 3, I just think about even just person on the street, even a non-business owner, and they say, well, this is kind of why I contribute to an RRSP, right? I get my tax refund, right? It's tax deferred. I don't earn any income. It's all tax deferred along the way. It's saving. So in this, it's like an RSP, except it's kind of like on steroids.
Yeah.
You're getting the tax deduction for it within the corporation. It's all being pushed back, and then you're not getting all that passive income along the way.
Correct. Well, let's keep going. Now, here's a really good one. So, of course, if you pass away, you can do a rollover of your pension assets to your spouse, just like in an RRSP. But if you have children that are part of your corporation, meaning they're not shareholders, but they're on the payroll, they get a salary for menial work or whatever work they do, they can also become members of the plan. And if death occurs, and I'm talking about a death where mom and dad pass away in a car accident, then what happens is all of that capital that's in the pension plan that's tax exempt continues to be tax exempt because it's now considered pension surplus. So the children, if they want to pull some of that money, they can, and they'll pay tax on when they pull out. But if they don't pull the money out, it just continues to grow tax sheltered for the next 5, 10, 15, 20, 30 years until they start taking a pension.
And we get this question all the time, which is you get to a certain life stage and you say, I realize I'm not going to spend all my money, right? You say, I've protected my capital, but generational wealth transition is an issue, and I want to be able to protect it from Ottawa as it passes down.
Well, the basic equation is, do I give $1 million in taxes to the CRA, or do I give it to my kids? If I prefer to give it to the CRA, then I stay in an RRSP, or I use my corporation as the primary method to save. If I'd rather give it to my kids, then I have to use a pension plan, because only pension surplus rules gives you this ability to skirt this deemed disposition. So then in the fifth tax, we were talking about folks who decide to become non-residents. Well, it turns out that every single penny in the pension plan is classified as an exempt asset and therefore completely outside of the departure tax calculations. So I have one client in Alberta that has $8 million in his IPP or PPP. If he decides to cross the border and retire in wherever, in the US or in Europe, he just saved himself quite a bit of tax just with this one feature. So the only tax that our pension customer is going to be facing is the fact that the pension that you're collecting every month is considered ordinary income, just like a salary would, while you're benefiting from that money in retirement. So a lot of people stop here and say, yeah, but this is where your solution crumbles, because if it's ordinary tax and there's a big pension, those dollars will be taxed at 53.5%. So we got you, JP. That's why we're not doing a pension plan. So let's look at that. What is the level of taxation for a pension that comes out of one of these plans? Well, let's look at if you're a non-resident of Canada, because Canada has tax treaties with about 100 different countries. And Canada has agreed that if you are in one of those 100 countries, the CRA will only levy a 15% tax on your monthly pension, not 53.5. Okay. And if you move to a tax haven, I had a customer move to Grand Cayman 2 years ago, and I had to look up these rules, and we don't have a tax treaty with Grand Cayman. So I said, I'm sorry, but your pension will be taxed at 25%. Still better than 53.5 in Canada. So not always 53.5 if you're non-resident. Now people will say to me, yeah, but most of my clients are not going to leave Canada, right? So what if you're a resident of Canada and you have a spouse, which a lot of people do? Well, if you do that too, things come in to reduce your tax bill. One is both of you in the couple can claim the $2,000 per year non-refundable pension amount credit. And then you can apply for pension income splitting and move some of that taxable pension income onto the tax return of your spouse, especially if your spouse has a lower or no income. Because when you do that calculation, you drop into lower tax brackets, and the couple as an economic unit ends up paying less tax.
You would only really hit that threshold if theoretically you were taking out 450,000 and maxing out your 225 each.
Yeah.
Right.
You don't have a single client that's collecting 400,000 pension a year.
Right.
So there's always a savings. And just for sake of argument, and I know this because I've presented it 100 times, in Ontario, if my pension plan gives me an annual pension of $169,000 a year, after splitting that with my spouse who has no income, the couple saves $17,400 in taxes every year. So that's, that's a small vacation to Tobermory, right? You have some nice fish and chips there. Okay. And then, of course, if you don't have a spouse and you are a resident of Canada, that's the worst situation. You still have the $2,000 annual pension amount credit. And then you're taxed in graduated tax brackets as ordinary income.
I mean, the truth is, if you have set up a structured plan as a business owner, as a high-paid executive, ultimately the good news is you're going to have a larger pension anyway. I mean, the worst downside to all of this is you actually will have saved more and paid less tax along the way.
Yeah, and what I find funny is people confuse absolute with relative. So they say, well, if your solution exposes me to a 53.5% tax bracket, I'm not buying. So I said to some people, okay, so if you went to California and you won that Super Bowl ticket that gave $1 billion, and California taxes it at 53.5%, so you're only getting $400 and whatever $million net of tax, would you say, no, I don't want it because it's taxed at 53%? Right?
Yeah.
Makes no sense. So conclusions, instead of exposing the assets of our clients to potentially 6 different taxes, we feel that using pension legislation, you should only pay tax once in retirement, so years into the future, and only on what you pull out, not on the rest of the assets that are sitting in the plan. Those continue to grow tax sheltered until you die, and then beyond when it's paid to your spouse or to your children. And we also feel that even though that one tax that our clients face could be high if you don't have any exemptions, if you do move to some of the jurisdictions around the world, Canada only taxes at 15%, and then some countries have agreed not to tax under local. So Portugal, for example, will not tax you on your Canadian pension income. So the only tax is 15% to the Canadian government. To me, that's a decent tax rate. I mean, it's a little bit higher than the DHST in Ontario. I can live with that. But this is not the end of the story. And we have some parting thoughts for you, because since the corporation is a sponsor of the plan, it may have some of those retained earnings that we discussed under the regular strategy. And if that's the source of money that we use to fund the pension plan, a bunch of things happen. First of all, 100% of the cash that's generated by selling those capital property is tax deductible when it goes into the plan, but only 50% of the gain is taxable. So that means that not only the corporation will pay zero tax for having sold those corporate investments, it will be in a tax loss situation, meaning that we can use those tax losses back 3 years and get refunds from CRA, or apply those tax losses against future taxable income for the corporation. So not only do we pay zero tax at point of transaction, we're creating extra tax relief for the corporation, which is nice. And then, as we discussed before, the other 50% of that capital gain is a CDA credit. So if you're collecting a pension that's taxable, you can supplement that with tax-free dividends. So your standard of living goes up without exposing you to higher tax personally. So that's a nice thing. And then the other final parting thought is yet another advantage of using the pension plan is that if the corporation is using those investment assets that's sitting in its non-registered account and contributing to the pension plan, in effect, what we're doing is we're purifying the balance sheet of the corporation in the event that the shareholders decide to sell the shares to trigger the lifetime capital gains exemption. So that's another $900 this year, and it changes every year. Another $971,000 tax-free capital gain on top of everything else we've talked about that comes with the package deal. Because we're purifying, we're moving stuff off the balance sheet into a pension trust, and it's no longer caught by those purification rules.
This is a conversation I have a lot, not just with my clients, but with colleagues, related colleagues, financial professionals. So if a business owner is starting to think, okay, there is an exit, right? There is an end game to being a business owner, starting to think about the balance sheet, starting to think about retained earnings. Is this the kind of conversation that they should be having 3, 5, 7 years before they exit?
Yeah, well, maybe not 7, but at least 3 years before they really sell the shares. They want to be able to put in these pension plans in place to clean up the balance sheet, to take those passive assets that are going to be taxed and move them into out of the system to purify, to give you the tax, the lifetime capital gains exemption, but also to reduce the amount of tax you have to recognize in the capital gains.
And in addition, if they have not been maxing out their RSP, if they have not been maxing out their contributions, you and your team can actually go back and calculate past service.
Oh yeah,
contributions they can make in and above and beyond what they may be eligible for
That's
today.
right. Because most business owners are so focused on growing their business, when they have disposable income, they plow it back into the company. They're not putting it aside for retirement purposes. They're thinking selling my business is my retirement plan. So here's an opportunity to do it properly, to diversify away from just using the corporation as a one stock in your portfolio, and to put that money in a tax effective manner in your own pocket right away through the pension plan. Now, some of you are non-business owner, they're executives, the C-suite executives, or highly sought after executives of larger companies or sometimes smaller companies. And normally we wouldn't be talking about all this stuff, but the truth is that we can offer a pension solution for that category. So we can do what is a combination of a personal pension plan, or if you want an IPP, we don't care, with a retirement compensation arrangement, an RCA. And what that does is that it allows the corporation to plow a lot more money into the savings accounts of the executive without creating immediate taxation in the hands of the executive, and while giving the corporation much larger tax write-offs. Because for the corporation, whether they pay a huge bonus or contribute to these two plans, it's the same deduction. They're indifferent as to which one to put the money in, but it makes a huge difference for the executive, because the bonus is taxed at 53.5% usually if it's above 200 and some thousand. If you can pay 0 and defer all that tax and have it grow inside of these savings vehicles, then you're much better off as an executive.
So is that a situation? So I'm working for XYZ company, I'm making more than 220,000. Is that a situation where I say, okay, I want to go back to the head office, to the CFO, and say, all right, instead of paying me my $150,000 bonus as cash, I want to set it up either with an RCA or a PPP and have that compensation paid directly in there?
That's right. So it's a discussion with the HR, with the compensation committee of the board, or whoever is looking after that for the executives. But it's a lot more tax effective for the executives and gives you peace of mind, because if you get fired or terminate or whatever, at least you have all this money that follows you, that you take with you And so finding another job that pays as much isn't as pressing because you have a safety nest egg that you were able to stash away while you were working. And the company, like I said before, they get a deduction whether they pay a bonus or put in these plans.
But at the end of the day, what's the number? 175,000 times your 18% of earned income, you max out your $30,000 RSP contribution. So this is a way to really, again, sort of juice up what you would do way above and beyond what you do through an RSP contribution.
I mean, we have some customers who, because their salaries are high, their deductions, their contributions, instead of being in the 30,000 range, are in the $100,000 range or higher. So it's a real order of magnitude difference. So just to kind of conclude, you know, the two strategies that we looked at, that we compared and contrasted, the corporate savings and the pension savings, both will allow the business owner to save money for retirement. We grant that. But because the pension strategy unlocks a series of beneficial tax consequences that are meant to preserve capital and grow it prudently, you know, a la Equate, that you know, makes that money go further, right? And we think that exposing it to multiple taxes is really not in the best interest of the client. If we can not do that by using pension laws that go back to the very first Income Tax Act of 1917, so it's well anchored in our tax code, why not? Why not use pension legislation to benefit our business owner clients or our senior executives that aren't owners, but that still could take advantage of these rules?
Well, you mentioned Warren Buffett at the beginning, and again, I'll draw on something Warren Buffett does as a strategy. I'm going to buy shares of a company. I'm going to find a great company. I'm going to hold it for a long time. I'm going to defer my capital gains because I'm not going to sell that. I'm going to hold it and hold it and hold it. So in essence, you're making a big, you're trying to front end that investment and create all of that growth, right, without paying tax along the way that you would, those tax drags that you talked about inside a corporation. And I'm building up a larger surplus, and I'm using that compound because it's not being chipped away at on the taxation along the route, and I have a larger pot at the end of the day.
Yeah, I mean, you know, avoiding or minimizing those death taxes or those non-resident departure tax, we're talking hundreds of thousands of dollars of savings. That you would have to work extremely hard as a money manager to generate that kind of wealth. We're doing it because of the structure, because of the law.
So let's just talk about that quickly, because I think, you know, the other part of this is, hey, JP, fantastic. I'm creating a personal pension plan. I'm able to put more away. I'm able to defer that taxation, creating a bigger structure. All right. So I put the money in a structure inside of PPP. Now I'm going to figure out how to invest it. And really, I think this is why JP and I have had such great synergy as we've started working together, is really my firm, the ability to really understand what then the ultimate goal is of the client, what their sort of investment objectives are. And so really we come at it two different ways. Number one is it's the custom built portfolio, which is, I know my personality, I know my objectives, I really know what kind of asset classes I like accessing. And that is our strength as an independent firm who can go out and find the best managers, the best strategies, the best asset classes in public and in private markets, and pulled all that together. And the beautiful thing is, it is just like an RSP, as JP said, there's no tax consequences. We can generate fully taxable income, dividends, capital gains, all of that is tax deferred within the pension structure. So we don't have to worry about the tax consequences the way we do if we're investing with inside a corporation, where we're trying to make sure that we don't generate too much interest income. And then to complement that, as almost as a turnkey solution, we've actually launched our firm as of 2 weeks ago, a pension-like portfolio. Really, in the, you know, CPP is ranked as one of the great pension funds of the world. And so we've built that portfolio for our clients. So it does have allocations to equities, to bonds, to infrastructure, private equity, across the board. So we are giving you inside the PPP a professionally managed pension style portfolio with liquidity, that you can continue to contribute to and access. So we've already solved the problem of what do you do inside the PPP in terms of professional money management. And then the last piece of this, which is really cool, this is really the power of bringing all of this together. As we get into the discussion with small, medium-sized business owners, they say, well, you're giving me a great tax strategy, you're giving me great investment management, you're giving me great sort of compliance and governance over my pension. What about my employees? So this is a topic for another day, but I wanted to just throw this out there. We, JP and I, INTEGRIS and Equate, are partnering on the ability to bring sophisticated pension management to small and medium-sized businesses. So again, if you think out there, the typical small, medium-sized business, usually using one of the life cos as a provider, you're getting a balanced fund or some sort of choice of target date fund or other public market mutual fund. Well, I'll tell you, the data is pretty alarming that the average 5-10-year return on those portfolios is around 4 to 5%. Whereas in the professionally managed portfolios, CPP, Ontario Teachers, they've been averaging 8 to 9%. So it's twice the return over the last 10 years. So you talk about the power of compound. So the really cool thing, and I literally am doing calls about this every day. I was talking with a company out in Saskatchewan, 20 employees. They don't have any access to the kind of investments that Canada Pension Plan is in a group RSP or a defined contribution platform. And now we're able to bring that to them and really elevate not only the pension strategy, the tax strategy, but also the professional money management.
Yeah. And good luck to you once China decides to invade Taiwan. You'll see what that account looks like.
Anyway, I'm going to stop sharing for a second. I do have one question. It didn't come through the Q&A, but someone had asked me who wasn't able to participate. Yeah, I mean, is there a way, again, we've talked very conceptually, and I sort of alluded to this during the presentation. But for someone who says, all right, can we actually see what this looks like before I make a decision, right? Before I say, oh yeah, sign me up. How does this work in terms of figuring out what I can put in, how much benefit it is, how it all works, how does the tax, how would you model that out for me?
Yeah. So we use actuarial software. We collect data from our prospective clients, date of birth, salaries, historical salaries, RSP room, existing RSP assets, and so forth. And we crunch it, we put it through our software, and what it does is it models out the status quo of just staying in an RSP, for example, or versus utilizing the pension laws to triple, sometimes quadruple the amount of write-offs that you're given with an RSP. And then we project that money over time. And then you see the delta between the two strategies. You can subtract our fees, of course, and you see the net delta after fee of money you're leaving on the table. And it's only after we've had that conversation that the client moves forward, because we don't want them to say, well, the delta is only 100 grand, that doesn't move the needle for me. I need more. I see there's a question.
Are there minimum or maximum contribution requirements that a corporation would have to fund into the pension?
So the beautiful thing is that the answer has two parts to it. If we're talking about non-connected executives, people that are not shareholders, there are minimum requirements, and actual science imposes a maximum contribution for a personal pension plan. To go beyond that, we need to layer on the retirement compensation arrangement. So a tiny fraction of our clientele fits into that bucket. Almost all of our clients are connected persons, meaning they own at least 10% of the shares of their own company. Therefore, their plan is exempt from the funding rules that are found in pension legislation. And this applies virtually across the country. So BC, Alberta, Manitoba, Ontario, Quebec, New Brunswick, Nova Scotia, and PEI all follow that rule. So if you're in any of those provinces, you as a business owner that owns 10% of the share of your own company don't have to put a penny in your pension plan if you don't want to. Obviously, you want to because that's how you get a deduction and that's how you put that capital to work. But for people who are afraid of cash flow availability, this is a non-issue. For the executive class, it's different. But presumably the company is much larger. There's a budget to pay for the salary and the bonus of that executive. So that's the source of cash that you'd have to put into those plans. So it's, you know, it's a manageable risk. So that's the answer. Depends. Are you connected or are you non-connected?
Yeah, so I'm going to say two things just to kind of wrap up. We've used up our 45 minutes. Number one, you know, again, as we said from the beginning, we had sort of different stakeholders here tuning in. We've got people who are business owners. We've got people who deal with business owners in different ways. We've got people who are executives, non-shareholders. The best sort of next step is really that one-on-one discussion about what's my situation, what am I trying to achieve, and again, whether you are a service provider, an accountant, lawyer, sort of benefits provider, because it's really a very personal, sort of individualized approach, and that's why INTEGRIS does those projections for each person individually and uses the actuarial math to kind of figure out what that plan is.
We also do them on an anonymous basis. So if you don't want to tell us who your client is, we don't need to know. We don't care. We just want to crunch the numbers and see whether the solution would work for them or not. So for those who are sensitive about, you know, bringing their clients to the table with an untested partner like INTEGRIS, that's not an issue because we process tons of anonymized quotes all the time.
And then the final piece is really just, you know, for us, bringing together the pension law and the pension management, the pension specialty side with the investment management side. We just, again, now it creates so many additional layers and so many additional opportunities when we are working with small, medium-sized businesses, when you're talking about corporate shareholder pension, corporate executive pension, and plan member employee pension. So really not only doing better tax strategies, better cash flow management, but also better returns, better risk management on the investment side. And so, you know, we're really excited. Obviously, JP has a fantastic reputation, as I've uncovered, as I've talked with other colleagues in the business. And we really believe the innovation in the space, in the pension space. And that's why today is so great, just as a first step in terms of educating and bringing awareness to what these opportunities are. And really, as we dive deeper with these small, medium-sized businesses and start to illustrate what the benefits can be, then it just becomes a snowball. So I appreciate everybody tuning in. Again, it's a lot of information, especially if you're not as familiar with the space, which is, again, why better to do sort of a one-on-one follow-up. I will send out the recording, I'll send out the slides, and we'll have the opportunity to talk one-on-one about ways that this could solve either you as a business owner or executive or one of your clients' issues in this space. So appreciate everybody taking the time over lunch, or again, for our West Coast colleagues, morning coffee. And I hope it was educational as a sort of a starting point, and follow up on any questions afterwards. Everybody have a great day.